Welcome to the Live Squawk podcast, where professional traders, investors, and market insiders get the unfiltered insights that matter most. Stay ahead of the curve with expert interviews and exclusive market commentary. Good morning, good afternoon, good evening, and welcome to the Live Squawk preview show. Today, we're focusing on the non-farm payroll out on Friday, 8:30 Eastern Time, 13:30 GMT, and today's Bank of England rate decision. The Bank of England is due up at midday Thursday, the 6th, and we're looking for a 25 basis point cut. But we're getting into all that with my two guests, Beat and also Jamie Dutter. But we'll first, just anyone new to the stream, we are Live Squawk. We are an audio news streaming service. You can find us at livesquawk.com. For those that use us, they know that we help really a number of eyes and ears on the news and all the social media platforms. We aggregate the news for traders and brokers and anyone basically interested in the markets. And so please trial the service. Also, just note, just a quick disclaimer, nothing that's said on this show should be taken as advice, trading advice or investment advice. We are not here in that capacity. We're here simply to offer you some insight into the key events of the week. And with that, I'd like to introduce my guests, Beat, and as I said, Jamie. Jamie, welcome to you both.
Hi, Harry, and hi, Jamie. Thanks for having me again. Looking forward to talk about non-farm and Bank of England. And yeah, thanks very much for
lovely discussion. Yes,
letting me on again.
Jamie.
Yes, thanks, Harry, for having me again. A pleasure being here. So yeah, appreciate it, and looking forward to a good chat.
It's always good to have you both. Right, I'm going to kick off with non-farm payroll. I'm just going to give a quick update on what we're looking for. There is a graphic we've done today, and if I find it, I'll put it up. I'll get it in a second then. So basically the long and short of it is we're looking for non-farm payroll of 170,000 is the average expectation for tomorrow's non-farm payroll. And that really, again, if you look at some of the numbers we've had of late, really comes in around about the mark of what we've seen recently. Let me just get my graphs up because they're not in any particular order at the moment, and it's annoying. But I want to give you some of the bank ranges for this data, so we've got something to view. And I'll try and share my screen for this, but my PC is acting all slow at the moment. Bear with me. Right, okay, yes. So median estimate then, 170,000. Unemployment rate expected at 4.1%, and we're looking at a 0.3% average hourly earnings on a month-over-month basis. Year-over-year, seeing at 3.8%. At the line of the range, you've got the likes of Santander, look for 135,000. At the high end, you've got the likes of Bank of America going for 200,000. I picked Bank of America's piece here because they're more optimistic than most about payrolls. They forecast 200,000 increase above the 170 average gain over the previous 3 months. Private payroll should rise by 170,000. We look for a 1 month decline in average weekly hours to 34.2, which should mechanically cause average hourly earnings to accelerate by a tenth to 0.4% on the month. On the household survey side, we expect the unemployment rate to remain stable at 4.1% and the labour force participation rate to rise a tenth to 62.6 after remaining stable for the three consecutive months. Analysts noted that a wide array of factors, including 1, the wildfires in LA and snowstorms in the Midwest and South, 2, potential residual seasonality, and 3, the benchmarking of the establishment survey, and 4, the population update on the household survey, which will impact the Jan jobs report. So with that, I want to turn it to our two guests. We'll start with Pete. Would you? What are your views on tomorrow's non-farm, which, as I said, is out at 8:30 Eastern Time, 13:30 GMT?
Yeah, to be honest, I think we have to be a little bit careful right now with all the drivers and what's going on out there. And I guess the market is pretty overwhelmed with all sorts of news having to be used again to watch every word that Trump is saying, the whole tariff story, and so on and so forth. So we have to have that on the one side as well by not probably overplaying the non-farm payroll data. The interesting part for me now is, we come from a sort of total outperforming of US data to suddenly start realizing a few wobbles. We had the obviously manufacturer ISM was stronger, but we know the US isn't actually producing anything. But the more important service ISM was quite a bit weaker. We had the jolts that were weaker. The gap maybe, or the bigger dip maybe has some explanation somewhere, but reality for a market that is used to have data surprises, we suddenly start to enter a phase of data misses. I think that is very key right now because no doubt about it, we have a dollar rally that lasted for 4 or 5 months in September. We had obviously the Trump trade in fixed income, and suddenly everything starts to stall a little bit since the kick in the long grass with the tariff Canada and Mexico. So sorry to but I think this is really the background. So I'm not too sure how. Let me rephrase what I said this week to some of the people I speak to is that for me, given what the Fed has priced now with the January and the December meeting, the first cut maybe in June, maybe some banks say no cut at all this year, means for me the market is so well priced that when it comes to data, is a clear asymmetric risk now. Meaning, for me, weak is weak. Meaning that's not priced. Strong, yeah, whatever. So I'm only focusing on weak data now because that's where the surprise is. The market is priced at, like I said, a few banks are now as far as saying that the cutting cycle is over. So there can only really be risk on the data miss side. So, if you get a bit stronger data, I will just point blank ignore it. If I'm really honest, I'm only focusing on weaker data now to see if actually together with this whole tariff story and the whole fiscal side that may be a big topic later in the year, suddenly, when the data starts to wobble, maybe suddenly the story is not as clear anymore as people thought it will be. And so that's why I still think there is a risk in the dollar. We see the dollar yen, it started to wobble. That has obviously some reasons also from the BOJ, hawkish BOJ in January. Then I think something I tweeted out yesterday, which I think the market just missed because not many people, maybe as old as I am, when Weda mentioned deflation is over. That's a very, very big statement, the first time in 17 years. So I think what you see on the yen strength is basically both dollar weakness and yen strength. So we are in a very interesting period now where suddenly the market starts to actually focus also on risk, what tariffs could do to the economy. Equities are very highly priced, so that is a little bit of a worry. So I think it boils down to that maybe non-farm payrolls is just yet another risk event where we're going to have a few hours of fun, but it actually matters very little to what's actually going on. That's actually my core view. I think it's just not important enough, other than maybe on the day. I don't think it's going to drag into next week. We have a lot more important things to worry about.
Well, yeah, and Jamie, how do you see that?
Yeah, similar. I think on the non-farm payroll impact. I think one bank had it. If only it mattered, and not far from me to get invited onto the show and then not big it up. But I think Beat's right. Really, there's so much else going on that non-farm payroll, as big as it generally is, may not have that big an impact unless obviously we get that outsized number. But again, I kind of agree. If it's an upside surprise, then that won't impact as much as certainly a downside surprise to the whole report. Sort of in amongst the detail, I guess there's this complication with the annual benchmark revisions that you sort of touched upon, Harry, with the seasonal adjustment factors and then that birth death model. Last time I think we had the BLS overestimated numbers by a third, if you remember, so sort of over 800,000, I think. And then the average, was sort of downgraded from, I think, over 240,000 to 174. So that didn't really have an impact last time around. It sort of filtered in, didn't it? And I think the final benchmark revision to March 24 payrolls we actually get today, if I'm not mistaken. It gets issued today. So that might be a small complication. Unemployment, that may rise because if you remember again, it's drawn from the household survey, and that registered a massive rise last time in employment in December, but a more modest kind of half, about 243,000, I think, rise in the labour force. So if we get some sort of mean reversion there, potentially, that can have an impact on the unemployment rate. Otherwise, as Bert said, there's sort of mixed data from all the other indicators, really. Jolts we had. I think we pointed out, and we've spoken about it before, with a quit ratio. And that's been falling, so it's cooling. So obviously labour market is then, there's better, sort of fewer opportunities, if you like, or fewer better opportunities, sorry. So that's kind of pointing to cooling. That's a good indicator of wage pressures as well. And otherwise, the NFIB, we've referred to that previously as well, small business hiring plans, that's sort of actually been rising back end of last year, sort of August to December, but we haven't had January's yet. So that's sort of the detail around the report. But I think, as Bert said, I couldn't agree more with so much of everything else going on that, with tariffs, obviously, and also with the Feds just saying they're going to be on a prolonged pause, really. I think labour market conditions, Powell said, he said they remain solid, broadly balanced, and kind of repeated again, it's not a source of inflation, so pressures. So,
So what I'm hearing from you two, and we've been here before with these numbers, but so is there very little in tomorrow's number that you will look for in order to inform your forward views? I mean, is there very little into? Look, we've got the noise, as you said, we've got the noise of the wildfires and of the other weather anomalies as well. So again, just a little bit too much noise in this number in itself, and the revisions and everything else to make it a tradable thing.
Yeah, I think there's meant to be limited impact from the fires anyway, I think, isn't there? Because it was generally residential, not businesses. And then we didn't really see an increase in the weekly jobless claims numbers. So I'm not sure that'll be any impact maybe on the unemployment rate. But aside from that,
good stuff. All right, then. I want to turn to, we'll stay in the US. Before we get onto the Bank of England, I do want to turn to, what has really driven market volatility this week, and Trump and the tariff talks. In terms of how you've traded this and how you view everything that we've seen so far, what do you make of it all?
How long have we got?
You want a short version or the long version?
Only about 35 seconds would be great.
Okay, No, to be honest, I think I have a sort of dual approach, because I have sort of two set of views. Well, actually three, but one includes sterling, which I say for afterwards. I've been very much all over the dollar yen side. Usually I've been running short dollar yen and cross yen into sort of these broader risk events like we have with the tariffs. But I kind of got the feeling this time that the missing link is dollar yen, especially with US yields actually topping on the downside and starting to drift lower. I also noted back in December and early January that suddenly we have some mysterious sort of sellers up at 157.5 in dollar yen. It just felt Japan is so keen, as we saw again with the headlines today from Shiba, to be on the right side of Trump. So I just felt that maybe Japanese don't want to have dollar yen close to 160 with Trump coming to office, making Japan a target on maybe also the tariff gun. There's just something out there. This whole combination seems to start to work now. The more hawkish Bank of Japan, the idea that GPIF suddenly allowed to buy JGBs, which would allow the BOJ to maybe clean their books a bit faster, make interest rate policy a little bit faster as well. Like I said earlier already, the comment about inflation is now the talk of town, or deflation. So suddenly this whole game is changing a little bit. In this as well, I think the market is getting nervous. The market starts to understand that tariffs this time is maybe different to 2018. Also, I think one can't remember if it was Goldsby from the Fed or one of the others overnight said this time the story is a bit different because tariffs seem to be broader, bigger, on a bigger amount of the economy, and the whole pass-through on inflation, this and that, and blah, 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 I spare you the rest. So I think there's a clear risk on the equity side. There's a clear risk on the carry side, dollar yen, cross yen, and we can just feel it. Yesterday, a very classic day, we had broader dollar weakness in the morning. As soon as we had hit the weaker ISM, actually, reality is the dollar should have continued, but the only dollar that continued was dollar yen, while the others stopped and cross yen started to leak. So there is a worry out there, and I can't put the finger on it yet, but there's something in the air which the market is realizing, and it can't put the finger on it yet. So
you said that before, and I tend to, I don't know. I mean, everyone just seems to be recoiled and ready for something else, like you say. And you've been around a long time. You see these little tells in the markets, I guess, and you're seeing one at the moment. Then, okay.
Yes, absolutely.
Excellent, Jamie.
Yeah, where do we start? I'm interested with the yen.
I'll narrow the question a little bit because I think it's unfair to sort of say, tariffs. Tell me about it. But in terms of where do you see the risk? What are you most focused on from the current? It's not turmoil because he's basically postponed a lot of the tariffs. Is it the China story above the Canada and the Mexico? That was just listen. As far as I can see, as far as people have analysed, that was a leverage move, and it's worked. Both borders are now going to get 10,000 more bodies to man them. So it's done its job on that respect. So that's not a trade issue. That's a political and immigration issue, like we've talked about.
Yeah, I mean, absolutely. I think sorry to cut you short. Yeah. The fentanyl czar is the classic, right? It's just grandstanding. It's meaningless. If you look at any charts with, Canada's fentanyl imports into the US and even immigration, you can't even see them on a bar chart compared to Mexico and the Southwest. So, that was just grandstanding, I think, just to kick things off for me. Obviously, we're waiting for the EU tariffs to kick in. Potentially, and again, it is a sort of escalate to negotiate stance, isn't it? I think.
So we can cut those off. So what I want to get back to for the people listening, for the traders out there, when the headlines come through, it's really we should be focused on China. Basically, is what I'm asking. It should be the Chinese story and how far and how deep they want to take this sort of tug of war, I guess.
And again. Sorry, go on, Bert.
Sorry, no, I was just quickly trying to jump in. For those that are maybe not as long in trading, just make sure you have dollar CNH up. Dollar CNH gives you it's basically the sort of mirror that will tell you how bothered or not bothered the market is. So funny enough, we only just started to creep a little bit higher again in dollar CNH until just yesterday. Really, the market was the initial tariff bomb. We got a big jump higher. That was obviously Sunday night. We can't take that one too serious. And then we just dropped again down to like 728 in dollar CNH. And we're sitting there, meaning the market is not bothered about the 10% at this point. Why? Because Trump talked about 60% in the during the election, right? But, and this is the big but, which we don't maybe fully understand just yet, is on how many products. Is it going to be 10% on everything? That could be more than the tariffs you had in 2018. You saw the retaliatory tariffs from China. That's a joke because it's only about on 25 billion. Guess what? China doesn't buy a lot in the US, so there's not a lot of tariffs they can do. So I think
that's the really important point there. Sorry to cut in, but it's just the difference between Trump 1.0, if you like, and now, right? And the difference between the US and the China trade relationship, because the US imports a lot less goods, than 2017 or relative to 2017. And then China, on the flip side, has found, replacement partners in Asia, and then it's also, set up manufacturing in Mexico. So the sort of, and that's why I think you said 20 billion. I thought it was 14 billion. It's like less than 6% of China's total imports into the US. So, it's strategic and it's targeted, right? And it's not meant for any escalation, you would think. And that's why we've seen that sort of 730, 750, barrier in CNH that you were talking about. But we didn't really get close to it, right? And when it spiked up and then collapsed. So, I think that's a huge point. The difference in the relationship now between US and China. Everybody says China's, in a really bad spot economically, obviously with real estate and so forth, but also the US sort of relationship has changed on their side, I think.
Yeah, I would also add, Harry, maybe our focus should be on Europe. Because I strongly believe the tariff gun is pretty solidly loaded towards Europe. And I'm not sure what Europe can offer in return right now, other than the joke he made that they could buy more oil out of the US. Maybe that's the clue. But I think with Europe, he really has a few issues with Europe, and Europe being Europe.
He's got a lot of issues with this.
Yeah,
with,
and Europe being Europe, they think they're like that special, right? And if you listen to what Lagarde said, what von der Leyen said, if I were Trump, I would already probably have fired that tariff gun. But anyway, I would say China is really my smaller concern. And if I may just finish off with one thing. The only thing I'm very happy about Trump 2.0 is that there is one adult in the room at least, and that's Bessent.
Bessent
is a solid guy.
I couldn't agree more, to be honest. Yeah, absolutely.
He gets the ear from Trump or not in regards to how he should be doing it. There's a story last night about they're focusing on 10-year yields rather than asking the Fed to cut rates. So there is intelligence now in the room. The only question, which we do not yet know at this point, is Trump listening or not? Hopefully he doesn't listen to Navarro, because that guy we know, loose cannon. But Bessent is really the adult. So if Trump really starts to listen to Bessent, then maybe things are a little bit, smarter than they used to be. Let's put it this way.
Right. So I want to move us to the Bank of England now. And so you've missed all I had some insightful comment. I can't remember now. Anyway, yes. Barclays on the Bank of England. Bank of England expected to cut interest rates by 25 basis points today. And that would bring the rates to 4.5% from 4.75%. Jack Meenan of Barclays said he expected the NBC to cut the base rate. They look for a 7-2 vote in favour. I know there is this is up for discussion. Some have gone for 8-1. And some are potentially saying 6-3. So there's risks either side of that number, really, the 7-2. But they see the split most likely 7-2 in favour, with two dissenters preferring to hold the bank rate at 4.75%, but acknowledge that a risk that uncertainty means we see a plausible range of between 8-1 and 6-3, and would take no strong signal for future policy from any outcome within that range without additional guidance. More generally, we expect the broad guidance to remain unchanged, leaving the MPC maximum optionality for future meetings. The meetings will see an updated MPC forecast, that's monetary policy, NPR forecast rather, and the results of the annual supply stock take. So just in terms of the Bank of England, and I know you've got a lot to say about the UK at the moment, and we'll give you, I'll unleash you. I'll unleash you in a second. But I'll start with Jamie, and then you can counter anything Jamie might say. Jamie, what are your views on today? And well, today's a done deal pretty much, and the markets are pricing in. Was it 1.25 at the moment? Cuts at 1.25 at the moment, I think. How bad do you think the situation may get for them to change that view? Do you think there's any change to the messaging today, or do you think they'll stay the course and just wait it out and see for the next?
I don't think. I think the latter, right? So I don't think there'll be a material change in guidance. They'll just retain that sort of optionality, that flexibility, really, and possibly then the dovish surprise is the vote split. I know some people have mentioned Man possibly moving across. I don't see it myself. And then possibly some sort of GDP downgrade, because we get the forecasts out, the quarterly forecasts out today, and then possibly Governor Bailey, tweaking his language possibly in the press conference and just referring to that sort of uncertainty and possible, more muted economic outlook ahead. There is a sort of hawkish side, perhaps, if we do get fewer votes in favour of a cut, that could be more hawkish. And then also, if I think government spending, if that's kind of flagged as a decent force in the growth picture, then potentially, that could shift the balance, because I think most people are like Bayat and more dovish than hawkish, so then you've got that sort of symmetrical difference there if it is more hawkish than we expect, because I think most people are positioned, or a lot of people are positioned for this more dovish stance.
Yeah, given the risk that we have at the moment and everything else. But I mean, just in terms of the UK, just to note, we have seen a general deterioration in growth, and growth has not been great anyway throughout the course of 2024. We saw a rebound from a 0.1 contraction for, I think, October, rebounded to 0.1% growth rate for November. We haven't had December's numbers yet. We're looking at the unemployment rate that's ticked up to 4.4. Is it from 4.3%?
Yeah, but those numbers are fairly, they're sort of racked by statistical issues, aren't they?
We can depend upon it. But then again, the sticky point, I guess, is the inflationary outlook. We saw that PMI reading, and we've seen services inflation has come down in one measure, but there are worries that services inflation remains still too persistent on the whole. What are your views on the Bank of England and more generally the UK economy?
To be honest, I agree with Jamie. There's definitely, if you just talk about the short term, the day event, definitely the market is more skewed towards the dovish side of the outcome. I definitely look for the forward. I definitely look for this mixture of downgrading growth versus sticky inflation. It depends on how strong they lean on that stagflation story. I don't think he uses the S word because he's probably going to be nervous that something's going to happen. But that is really my focus. So on the day, to be honest, I'm core long Euro Sterling from back end of last year. I lightened up a little bit in this first leg up that we had and started to build a position into this recent dip, because I just think I'm a monster bear for sterling for the year. I think the economics are just terrible. Rachel Reeves is terrible. The budget is terrible. The sentiment
don't hold back, Bear. Don't hold back.
The sentiment in the UK, the business sentiment, if you listen to some of the business leaders, they say that sentiment hasn't been that bad for a very long time. We see the impact. We see that medium-sized SMEs start having to let people go to pay for the national insurance or other sort of silly things in the budget. Third runway in Heathrow, okay, good idea 6 months later, but that doesn't really bail out the economy in 2025. So I think, there were some rumors today about Starmer replacing her, but let's see. I don't think there's a lot more capable people behind. Generally speaking, I think.
So it's just on that note, that would send a very, very poor signal in my mind. You've nailed your colours to the mast. You're going after this particular plan, and 6 months in, 7 months in now, 8 months, whatever it is, you're now going to change one of the orchestrators of that economic.
Exactly.
Well, I think,
I really think, to be honest, the UK also with all these extra borrowing, this and that. Reality is she just nuked the people that should create growth, and that's why I'm very bearish on sterling. So today, to be honest, if the meeting is a bit more hawkish, if you talk short-term trading, we probably have a little bounce in sterling. But as a medium term, I think Bailey, if he's honest today, he will actually probably spell out what the issue is, and this is we have sticky inflation versus horrible growth, right? And that's just so. I focus on the stagflation story because there's no way to avoid it. I really don't. I can't see how, right? So this is my core view. So that's why today, sometimes I'm focused on the short-term events. Right now, my view on the UK is far too big to be bothered about if it's a 8-1 or 7-2 or whatever, because I think it doesn't matter. Maybe sterling has a little bounce, but I think the UK has really far-reaching problems that are way beyond. And to be honest, a sticky like I agree, there could be a small hawk, but let's be honest, the hawk in the current situation is not really bullish either for sterling, right?
Well, I think it's interesting that people have cited about the increase in government spending being a positive factor for the UK economy this year, but then that kind of brings into question about productivity, right? Because then the UK is reliant on public spending rather than private sector activity, and then we go back to that productivity question that has been lingering, it seems, in the UK for kind of decades, right? But near term as well, or not near term, but after this meeting, I think definitely the fiscal event in March, right? The end of March, the OBR revision to their 5-year forecast, that will be a big event, no doubt. And then also we do have the labour market impact from after April with the NIC, so national insurance contributions and the national living wage. So, those are small things that could impact then the MPC going forward, and possibly more cuts, after we got over those events, I think.
Yeah, fair enough. I just want to, just to give you, just for those who are unaware, there's a monetary policy report that gives updated staff projections on the growth, labour, the economy, basically. Just to quickly note, the November NPR was looking for inflation at 2.5% in December, and on the end of quarter at 2.4%. Services inflation at 4.9%. We've actually, I think, come in at 4.8%. So it's just it's running roughly where the bank noted. Same with the headline inflation. They were looking for 2.5 at the end of Q4. It's running at 2.4% according to data. Again, the worry has been the wage front, really, and that's still again way above where I think they'd like to see it. I think private sector regular wages for November at 6%, which was a bit of a shocker, and at end of Q4 they were looking for 5.1. So again, in these numbers, there's enough there for them to look at. But I think in terms of the guidance, in terms of the projections, I think most are looking for slightly weaker GDP growth trajectory and higher near-term inflation outlook is the general feel. So again, it's going to be more in the detail, devil in the detail, and in these new growth forecasts as to where markets think the bank will go. We're running out of time, so I want to sort of round it up now. So in just to get it back to the trading for the next couple of days. Or not more than the next couple of days. In the way you guys trade or look at the markets at the moment, I'll come to you first. What are you most Are you a short-term trader at the moment? Are you staying nimble, just running low positions at the moment and just being ready for a headline?
Yeah. To be honest, the core is ex sterling. So sterling is a macro position. The rest is all very, very fast on the feet. Always, the bias is here to sell any rally in dollar yen and cross yen, but as you pointed out, right now it's a headline bonanza, right? So you're better off respecting, tariffs or no tariffs and all these sort of tweaks and twists. I think the dollar is unclear. As long as the tariff risk on Europe still persists, I think we can't have a real correction in the dollar right now. So that makes me also unsure about the actual core dollar outside of dollar yen. So I'm just playing short term. So I might be part of the, a quick hawkish Bank of England or dovish. I might be quickly all over non-farm payroll if it's like a big miss or a big, I trade a big miss, definitely. I might trade a big beat as well, just for the very short term. But generally, the bias is really more risk off, stronger yen, weaker sterling, and the rest is just hit and run trading until we know more about the fiscal plan in the US, as well as all the tariff stories.
Fair enough. And Jamie?
Yeah, similar with the yen for sure. I think especially with some of the crosses as well. So they're sort of not hostage to, headline havoc or tariff, havoc and headlines. Less so. I think underlying bid to the dollar generally. Euro sterling, I'm probably the opposite way to bet, to be honest. Favouring the UK just about as a better of the bad two. just because the Bank of England might be more relatively hawkish, I think. Otherwise, tariff fatigue is probably it for me, potentially, because the bark is bigger than his bite, and then we potentially might move on, even though some of the initial announcements are huge. We're kind of learning to live with how Trump 2.0 operates, basically.
Interesting. Okay, well, guys, listen, thank you both for your insights today. Much appreciated as ever. Again, anyone, we've got 40 minutes now before the Bank of England today. Obviously, non-farm is on a Friday, so it's tomorrow at 8:30 Eastern, 13:30 GMT. I'll post up the links for both our guests, be it Newsbammer of Macro Beat at the macrobeat.com, and Jamie Dutter there of PIQ, the aggregation news service. So I'll put both the links up there for you. Again, if you want to listen in to today's Bank of England rate decision and press conference and comments coming from that, please go to livesquawk.com, take out a trial and see if it can help your trading day. And also, same goes for tomorrow's non-farm payroll. Livesquawk.com. Try us out and see if it's of any use to you. But thank you both for your words, and we'll see you again next week, everyone. Thank you very much.
Thank you, guys.
Very much for having me, Harry. All the best for everyone. Bye.
Always a pleasure, guys. Thank you. Thanks for tuning into the Live Squawk podcast. Your edge in the market starts here. Subscribe now.